welcome everyone. It's great to see a really nice group of participants in today's session, which is the second masterclass on corporate strategy organized by the SMS Corporate Strategy Interest Groups. We're delighted to have today two wonderful speakers, Robert Hoskisson and Belén Villalonga, joining us as experts on diversification on the session that Katie Magelssen from London Business School has so wonderfully organized. So with just a couple of thoughts on or words on our speakers to introduce our speakers. Robert Hoskisson is the George Brown Professor Emeritus of Strategic Management at Jones Graduate School of Business at Rice University. Over the course of a very accomplished career, Professor Hoskisson's research has focused on the impact of corporate strategy on performance, and he devoted an important part of his research to understanding the relationship between corporate diversification strategy and performance and innovation, explaining how such diversification is facilitated through acquisitions, divestitures, alliances, and joint ventures, both in the domestic market and internationally. Professor Belén Villalonga is Professor of Management and Organizations and Yamaichi Faculty Fellow at the Stern School of Business at New York University. Professor Villalonga's work focuses on family businesses, corporate strategy, and corporate governance. And in addition to her work on family ownership and control, Professor Villalonga has also studied extensively the area of corporate diversification, examining in particular the existence of a corporate diversification premium or discount. So the SMS Corporate Strategy IG is delighted that Bob and Belén have kindly agreed to do a masterclass on corporate diversification. So thank you again. Thank you, Bob. Thank you, Belén. Thank you very much for joining us today and sharing your insights from your work and from this area. Bob and Belén will each speak for about 20 minutes, starting with Bob, who will provide an overview of research in this area, and continuing with Belén, who will focus on corporate diversification discount and or premium. We'll reserve the remaining time for questions and answers. So for that, please post your questions in the chat function that you have in Zoom below throughout the talk. At the end, we will come back to these questions in the chat in the last part of our session. So without further ado, I'm going to pass this to Bob. Bob, at your request, I will set a timer so you'll hear some bells chiming in the background in about 20 minutes when it's time to wrap up and pass it on to Belén. Thank you again, both. Bob, the screen and the microphone is yours.
Okay. Oh, I got to share screen first, don't I, here? Share screen. Let's see, who can share screen? Only host? Let's see.
Try now, Bob.
Okay. Hang on here. It's still asking these options here. There. Okay, there. Okay, so when I was a doctoral student, I ran into this diagram in Dick Remelt's book in 1974, and I was enthralled or interested in this about how the product diversification, product divisional structure had replaced the functional structure in the Fortune 500 firms in these 20 years. And I really was enthralled with studying that. So that became my dissertation. Also at the time, Oliver Williamson had produced his book, Markets and Hierarchies. And he had this M-form hypothesis suggesting that the multidivisional form was more efficient than the functional form. He called them M-form and U-forms, respectively. So that's what got me into that. And that led me into my career, basically. So I started studying corporate strategy and in particular M-form implementation. If you look lower, I studied product diversification, international diversification, anything around the corporate office, acquisitions, divestitures and restructuring, divisional control systems, and then how do you control the corporate office? You do that through corporate governance. So I studied ownership, boards and executives, executive compensation, and ultimately country institutions. And I've looked at financial performance and commitment to innovation as key dependent variables. So that's kind of my career. This is some self-promotion. This is a recent book published in August of 2021 with Wei Shi, a former doctoral student at the University of Miami. And this book, each chapter is about how governance influences a particular strategy like corporate strategy or business level strategy or international strategy, stakeholder strategy. So this, again, this is just out. So historically, there's kind of two branches of the research on diversification. One would be found in finance and IO economics. And from the beginning, from my point of view, long-term abnormal profits from diversification are unlikely, just because of the nature of competition. So markets are relatively efficient from that point of view. Alternatively, agency theory and the resource-based theory suggests that markets are relatively imperfect. And you also have this branch from finance, really talking about market, how the market discounts diversification due to managerial incentives. And I'm not going to spend any time on that. Belén will go into that and does a great job explaining this area. So starting with Rumelt, related diversification is based on firm level capabilities. So here's a kind of a model, a beginning model. So you have these firm resources and you share resources among divisions, and that leads to corporate diversification. And you have dynamic capabilities, the ability to facilitate change, knowledge, and institutional environments. And all these things influence financial outcomes. I'm going to add to that model a little bit later. So this is probably one of the most cited pieces, this inverted U-shaped relationship by Palich, Cardinal, and Miller in 2000. I think this is an SMJ, where it shows dominant businesses have a lower level of performance, and related, or especially related constrained businesses, have higher performance, and unrelated businesses have lower performance. So at the beginning of my career, I hooked up with Charles Hill, and we developed a theoretical model talking about how firms have to process more or less information depending on the strategy type that they implement. So if you have information processing, F is basically financial controls, that it implies unrelated diversification. So if you don't have to process a little information, a lot of information, you can have a lot of divisions. If you and this underlying this is different types of interdependence. So pooled interdependence, from Thomsonian logic, serial interdependence for the vertical, and synergistic would be reciprocal interdependence. And the reciprocal interdependence implies, you know, the more you share among all your divisions, the higher the information processing to manage related diversification. So I studied M-form implementation with these three strategy types, if you will, in an earlier piece as well. And this was published in 1987. And I was testing the M-form hypothesis, basically. So I had 10 years of data before implementation and 10 years of after implementation. And you'll see that in the unrelated firm, the implementation of the M-form went up. So ROA increased, and in fact, adjusted standard deviations would be an indicator of risk. So performance goes up and risk goes down. That's really good, right? Again, this says adjusted means, adjusted standard deviations, because this was an analysis of covariance, and that's why you have an F instead of a T. So there's adjustments going on with the control variables. Vertically integrated actually went down, although risk goes down. That might be a wash. And related diversification did not do so well, although you'll see that this U shape is here. So you have lower, so the vertically integrated firms would be dominant business, unrelated be, you know, and so overall, related firms perform higher than the other two categories. So that implies this curvilinear relationship that was found in the meta-analysis. So Evan Raleigh did this study on taxi cabs, which I felt his theory was really good on this. So he talks about diversification and then these potential economies of scope, but realized economies of scope may be a little different. And he focuses on several variables, including coordination costs. So as I implied earlier, as you do related diversification, your information processing costs go up. So that equates with these coordination costs. And you'll know that in a related diversified firm, you might have 1,000 people in corporate headquarters, 10,000 people in corporate headquarters, where in an unrelated firm, you might have 100 or 200. So these firms have a lot more information processing to handle, or coordination costs, if you're doing relatedness. And when you get firms that are related, diversified, it's hard to separate them, because you have, especially when you have assets that are mixed between the divisions. And this leads to organizational rigidity, right? Dorothy Leonard Barton probably has a signal piece there. But Raleigh and company also talk about when coordination costs become so expensive that you get diseconomies of scope. And then you get things like vertical contracting instead of vertical integration. So you have the taxi cab drivers becoming their own owners, and they don't have all the costs that go into that. So anyway, this is an interesting piece, and he has several pieces, one about diseconomies of scope and one about organizational rigidity. So if you look at some of his research, I think he has some good stuff, and there are others who have done stuff in this area. So another area is diversification over time, right? Scope economies occur through relatedness and best relatedness, and then you have these possible intertemporal economies. So things change, and when a firm enters a related business by redeploying its resources over time. However, you know, this relatedness leads to rigidity, as we suggested, and it's you're less likely to exit business that is more related to your other businesses. And you might get legacy businesses and family ownership that are difficult to get out of because they're connected to all your other businesses historically. So due to resource sharing links in related diversification, resource deployment is costly to reverse. So what businesses do you shed? Usually it's unrelated businesses or less related. So sometimes you get what is known as moderately related businesses, and it's usually knowledge sharing rather than asset sharing between the businesses. And those are the ones where resource deployment happens more readily. And that's what Sakartov found in this 2017 piece. I would recommend his work as well. It's really interesting what he's done there. We found this same phenomenon in a piece published back in 1992 in SMJ. And this was about the restructuring. What is the post-restructuring diversification strategy? So you have the pre-restructuring and the post-restructuring strategy. And what we found was that the mixed or related linked strategies, and that's where there's not a lot of asset sharing, like you might find in the related linked or related constrained. So the mixed or related unrelated, then those are the firms that were really being restructured. So you see related becoming more related and dominant becoming more dominant and unrelated not changing that much, which is kind of surprising. It's the related link firms that were being restructured. And that kind of matches this Sakartov finding, in my opinion. Shifting gears a little bit, I've done a number of studies looking at the relationship between diversification, R&D, commitment to innovation, patent intensity. This is one with Barry Basinger and I, where we looked at the relationship between diversification type and R&D intensity. So this is adjusted for sales, right? R&D expenditures divided by sales. And we found this negative relationship after controlling for a lot of variables. Mike Hitt and I found a similar relationship in his 1988 piece in SMJ. This was an AMJ piece. At the time, the research was suggesting that there might be this positive relationship. So the relationship empirically was quite surprising. Nelson talks about this positive relationship in 1959. So we looked at mergers and acquisitions. This basically says mergers and acquisitions through all these other variables lead to less commitment to managerial, less commitment to innovation. And this feedback leads to more mergers and acquisitions and even less commitment to innovation. Now, this is not always the case, but this is a theory piece, and we tested this and published in AMJ piece looking at both inputs and outputs to diversification. So we looked at R&D intensity as an input and patent intensity as an output and found this negative relationship. And it's interesting, we found in the earlier piece I cited, the Hoskisson and Johnson piece, we found that if the restructuring acts leads to a reverse, so that when diversification is reduced, that in fact commitment to innovation increases. So anyway, there's a whole bunch of a raft of studies on this topic, and I won't go into them any further. Also studied, and this was due in part to a doctoral student I had who did this dissertation, Bill Wan, who did a dissertation in this area. And we studied firms in Western Europe, and we divided the firms into countries that had weak market institutions and firms that had strong market institutions. And in those countries that had weak institutions, there was a positive relationship to diversification, and where there were strong market institutions, there was a negative relationship between diversification and performance. That led also into a bunch of studies on business groups and others, but this was kind of a signal piece, at least from my point of view, my research. So if you think about this as a cost, a country transaction cost, country level, and overall organization costs. So think as costs come down, as diversification goes up, if you have weak institutions, right? So you manage the institutional voids through diversification. And that's one of the reasons for the existence of business groups, at least purported reasons. But as you diversify, organization costs go up, right? So you come up with some kind of set point in the economy. And if you improve the institutions in an economy and you lower overall transaction costs for all firms in the economy, that suggests that the set point for diversification might be lower. So the average level of diversification in the country goes lower as you improve the institutions and reduce the transaction costs. So I have another set of studies that look at diversification and performance across, I don't have too many, but I have a few that look at this issue. And there are lots of other studies that kind of look at this issue as well. So if you think about reasons for diversification, to summarize, so you have economies of scope, market power, let's say vertical integration, and financial economies. But you also have to have resources to, so there's rational incentives and resources, but there's also managerial motives. So you have all these resources, but these managerial motives might destroy value if they over-diversify the firm. So if you think about these things, you have operational relatedness and knowledge sharing. Operational relatedness is, I infer that there's shared assets here. Certainly in vertical integration, there's shared assets. Related linked is this mixed, unrelated, related, and then you might have both, which is really difficult to do. And if you try this, I think this is what we were finding, where there was this mixed, related, unrelated, or the related link firms were getting hammered in the restructuring, and it's just difficult to do. So the incentives, right? Diversification. So the motivation, sorry. Diversification increases the size of the firm, size is associated with executive compensation, and diversification reduces employment risk potentially. Effective governance may restrict such motives. So if you think about all these things, you have these incentives, resources, motives, that leads to some kind of diversification strategy. But you have capital market interventions, you know, so you have activist investors now who are suggesting that, you know, these firms are over diversified, and managers might lose their jobs. You'll have this market for managerial talent that might restrict. And then you have these institutions that change the level of diversification. You also have internal governance, speaking about the boards and executive compensation that will affect diversification. And then you have structures. There are different structures to implement vertical integration, related diversification, and unrelated. As I indicated, related and especially related constrained firms have huge corporate headquarters, where unrelated firms have very small headquarters. So recently, I was a guest editor on a special issue at JMS with Marcus Mentz, Sven Kunitz, Julian Birkinshaw, David Collis, Nikolai Foss, myself, and John Prescott. where we begin to look at corporate strategy in the digital age. And this is one of the diagrams. You'll go blind reading it from this, but you might take a look at that piece. It came out recently, along with a bunch of articles that we accumulated in the special issue, looking at this issue of digitalization. So here's some questions that we might think about in regard to digitalization. Are digital technologies utilized to enhance synergies or shift decision-making? You'll recall that one figure where I had kind of a top level of information processing and the curved lines coming up. Jay Barney has a piece, for instance, where this is an AMJ piece. I could find a reference if you're interested, where information processing is increased and it allows the diversification to the corporate office to process more related diversification because of the technology for decision making. AI might facilitate this, for instance. How do these digital technologies impact the relationship between diversification and performance? There's some studies on a platform, different platforms, but we're just beginning to scratch the surface on this. And I think this is a huge area for us, especially when you look at firms like Amazon that are increasing their diversification all the time and vertically integrating too, back into transportation, et cetera, and servers, even chips. Looking at these, and also, do they reduce the trade-off between commitment and flexibility? What I mean by that is, when you go into related diversification, it's a stronger commitment, especially when you focus on sharing among assets, and it creates inflexibility or this organizational rigidity that I mentioned earlier. So is this trade-off reduced when you have digital technologies introduced? My guess is that it is, and I think Apple is more vertically integrated than other smartphone firms. So which scope choices are better for these large platform organizations? And of course, they all have different strategies, right? Uber is focused on, contracting. Some are really into diversification, like Amazon. So what are the best scope choices for the particular type of platform that you have? We just don't know yet. And what are the intra? So the scope choice would be an intra thing, but there's also inter-organizational changes and boundaries in the digital age. So Uber has relationships with people who deliver food, right? And so how does it change the alliances or the networks between organizations? These are huge questions that we really don't have answers to, and I think these are very ripe for opportunity for current research in this area. So, how will digitalization shape these relationships in the future? So basically, I'm done.
Wonderful. Thank you so much, Bob. You heard just a couple of minutes ago, you heard some chimes in the background. That was my gentle way of saying we should pass it on to Belén. So Belén, on to you.
Thank you. Let me try to share my screen. Okay. Yes. Okay. Okay, hold on a second, sorry. I apologize, but my Zoom doesn't seem to be seeing my presentation. Here we go. Okay. Okay, can you all see that now?
Yeah, it looks great.
Yeah.
We need it in present mode. Perfect.
All right, here we go. Now it would be good if I could. All right, that works. So hello, so hello everybody, and thank you so much for being here. And it's great to see some familiar faces and lots of unfamiliar ones. So welcome all to my part of the talk. And as Cinzi and Bob anticipated, I'm going to focus more on the part of the link between diversification and performance, but particularly the stock market appreciation or lack thereof of diversification. So which is what most of my research has focused on, as some of you may know. Sorry, I'm trying to organize my screen here so that I don't cover what I'm reading. Okay, so again, this is something that you all know, but basically views about the value of diversification have really swung like a pendulum over the past 50 years. Starting with the 60s and 70s, which was, of course, the heydays of conglomerates and the whole portfolio approach advocated by BCG and McKinsey took hold of most corporations. And so if we had to summarize the view at the time, it would have been that diversification creates value because it allows companies to do this kind of portfolio approach. In the 80s and early 90s, the pendulum swung, though, and this was became almost the heyday of refocusing, although I guess the recent events might lead us to question that. But certainly relative to the 60s and 70s, the emphasis was on this idea of stick to your knitting, and that's when this notion that diversification is in fact something that destroys value started to become sort of the dominant view. In the 90s and early 2000s, that was the years where there was quite a number of papers about this, in which I participated myself, all this academic debate about the existence and meaning of the diversification discount or conglomerate discount, as it's called indistinctively. And then in the wake of the financial crisis of 2008, 2009, however, there was a bit of a resurgence of conglomerates, and there was a number of articles that were appearing in the popular press with this idea that conglomerates might be in fact ready for a comeback. And this is supported by some evidence, and I did some research about this myself, which I'll talk about. But this is from a recent study by my colleague at NYU, Baruch Lev, who basically looked at sort of the conglomerate mergers in general, but sort of the percentage of mergers that are represented by conglomerate deals. And as you can see in that chart, from 2010 until recently, there was really quite a surge in the percentage of those mergers that are conglomerates. And again, as we know, most diversification tends to take place through acquisitions. I guess because you're sort of going into terrain that you don't necessarily know that well, and well, for other reasons as well. But so of course now in the 2020s, so this just past year, but even this past week, we have seen some breakups of what have been some of the most iconic, emblematic conglomerates in the world, and perhaps the most of them is General Electric, of course. That was always hailed as basically the mother of all conglomerates, and in the Jack Welch era, this was sort of a model for many other companies. And so GE is breaking up. Siemens has already broken up. Johnson & Johnson is at least spinning off a piece of it. Toshiba is also breaking up into 3 parts. IBM already did this last year. And so there had, Dow and DuPont merged, and 2 years after they merged, they were splitting up again. And there was sort of what we could call a trivestiture with the third piece spinning off. And so there's been not just a lot of these divestitures and breakups, but very significant ones in terms of value. And so it seems that the pendulum keeps swinging, and frankly, I think it will keep swinging back and forth for decades to come. And so let me say a little bit about this, what sort of the myth and the reality about the diversification discount. So first of all, what do we mean by diversification discount? In very simple terms, it's the conventional wisdom about the effect of diversification on performance. Very simply put, it's just saying corporate diversification is bad and stock markets know it, and hence diversified firms trade at a discount. The question, though, is a discount relative to what? And here I like to take a page from my finance colleagues' wording of this and talk about three forms: weak form, strong form, and semi-strong form, kind of like the three forms of market efficiency. And so the weak form basically says that diversified firms trade at a discount to focus companies in the same industries. The semi-strong form, the intermediate one, would say that diversified firms trade at a discount relative to what those diversified firms themselves would be worth if they were split into pieces. So obviously a stronger statement. And the strongest statement of all would be to say diversified firms trade at a discount relative to what those diversified corporations themselves would be worth had they not diversified. And in case this is not totally obvious, this is a stronger statement than the previous, because the previous statement it leaves room for the possibility that diversification was value creating at some point in the past, and circumstances may have changed, whether it's within the firm or in its environment. And now it just makes sense no longer to stay diversified, and more value will be created by breaking up those conglomerates. Whereas the strong form, as I have stated it there, basically leaves no room for that possibility. Now, what evidence do we have of each of these three forms? So evidence of the weak form, we do have quite a bit of evidence that diversified firms in US stock markets at least trade at an average discount, depending on the study, of 15 to 30% relative to their pure play peers. For the semi-strong form, the evidence, at least that advocates of this interpretation of the discount would give, is that stock markets tend to react favorably to announcement of spin-offs and divestitures, particularly those that are of a refocusing nature. And then evidence of the strong form, of course, we cannot have. What would diversified corporations be worth had they not diversified? Who knows, right? What would GE be worth had it stuck to making light bulbs? You just can't tell. And so all we can have about that is really an inference derived from the evidence that I just mentioned. Why is this even important? Well, if the inference is correct, it would suggest that there has been massive value destruction from diversification, depending on the estimates, in the order of $0.5 to $1 trillion in US stock markets. And yet we see that diversification is still important. Again, I just showed you that chart about conglomerate mergers, but in the studies I did, and this is a little bit old, so I don't know what these numbers would be like now, but diversified firms represented more than half of US employment, more than 60% of total assets. Given the decline in the number of publicly listed corporations versus private, I think it would be interesting to look at privately held diversified firms as well. There's also been studies years ago that basically took a look at whether, after all the refocusing trends of the 80s, the average company became more specialized to any particular industry as opposed to more diversified, and in fact there had been no such return. So net, there might be refocusing, but there's a lot of diversification going on as well, and so net it's not so clear. And so the interesting questions that this raises for academics, of course, it's why does diversification persist? This is, I guess I sort of share the Chicago view on this, that, if you see something, it must be because it's efficient, and particularly if you see certain behaviors over extended periods of time. And the question, of course, for managers and for our MBA students that we're all training is, what do we tell them? Should they diversify their corporations? Should they break them up? Should they do nothing about it? And so this continues to be an interesting dilemma, I think. And so let me tell you a little bit about the theories underlying some of these views. So I have them grouped here, theories pro-discount, and really what I mean by that is anti-diversification. So in the strongest form, this idea that diversification actually destroys value. So the classic views, of course, agency problems of various sorts. I won't get into the details. I've already talked a little about that. And of course, the inefficient investment view, which is something that was more popular in the finance than in the strategy literature. But this idea that essentially, not to say that managers are selfish, sort of like in the agency views, but just to say that they are simply not as competent as they think they are, and they are throwing good money after bad money. In the semi-strong form, this idea that corporate refocusing creates value, but doesn't necessarily mean that diversification was value destroying at the beginning. One explanation is this idea that there has been a secular decrease in the transaction cost of external funds. And so, maybe diversification made sense in the 60s and 70s because markets were not so efficient then, but now that they are supposedly more efficient, it no longer does make sense. And then for the weak form, this idea that there's a discount, even though diversification does not destroy value, there's different theories. One is sort of irrational fads among public investors. And then one that I think rings quite true to me is this notion of analyst specialization. This idea that because the analysts and investment banking professions are specialized by industry and continue to be, no single analyst can understand very well a conglomerate, and you do see this. I did a study with Emily Feldman and Stuart Gilson, where we actually looked at analyst reports for conglomerates that were about to undergo spin-offs. And you do see this kind of behavior where, an analyst, for instance, that is tracking US Steel when it was part of, Marathon was part of it, and they were about to do a tracking stock issuance. And so they would, if the analyst is specialized in steel, they will devote 19 out of 20 pages to steel, and then devote half a page to oil and say, oh, by the way, they have this oil division too. So that's, it's not clear to me why the fact that analysts don't understand conglomerates necessarily means that they undervalue them, but there's views about that. On the other side, theories that would suggest that diversification is in fact good, that there therefore should not be a discount, but more of a premium. We could put them simply. One is like more money. So basically, this is a classic finance argument in defense of not just related diversification, but more even so unrelated. So it's this idea that diversified companies can in fact borrow more because of the imperfect correlation among their cash flow. Then we have the smarter money explanation, which is saying internal markets can be more efficient than the external one, at least at certain times and places. And then related to this, it's this idea of institutional voids that Tarun Khanna and Krishna Palipu and others put forward years ago. And this idea that diversified companies can fill gaps in labor and product markets as well as capital markets in countries or regions of the world where those are not so efficient. So all of these theories would suggest that there should be a diversification premium. And then we have what I would call neutral theories in the sense of predicting neither a discount nor a premium, which would basically say there's an optimal level of diversification for each company, which is going to be determined by essentially a balance of their own resources and capabilities. And taking a page from David Collis, who I see is there, and wrote a wonderful book about this resource-based view of diversification, and so determined on the one hand by that and the ability that firms have to exploit economies of scope across their business, but also limited by entrepreneurial skills and manager skills. So what about the evidence if we sort of start to dig a little deeper about this? And I'm keeping an eye on the time here. First of all, the discount, so about value creation or destruction, the sort of a strong form of the discount. Well, turns out that the discount at which diversified firms trade in US stock markets is not attributable to diversification, but to various methodological issues. One is lack of true comparable focused firms. And I think even, people who do this for a living, again, investment bankers and others who do valuations always struggle with finding actually comparable pure play firms to do multiples valuation, which is essentially also what we academics are doing when we are estimating diversification discounts in conglomerates like you tend to find in the US, where you have a company that's publicly traded with divisions or subsidiaries that are not, and therefore you have to do some kind of estimation of their market values to compare the sum of the parts to the whole. So we have a few comparable focus firms. We also have issues of reverse causality, and this is part of what I did in my doctoral dissertation and subsequent publications, which I looked at companies that were diversified before they diversified, and it turns out they were already trading at a discount before they were diversified. So whatever it is the market was discounting, it was not diversification. And there is related self-selection issues. And so when all these biases are corrected, it turns out that the discount disappears or turns into a premium. And so diversification in that sense, I think it's fair to say that it does not destroy value, may even create it. And the strong form of the diversification is rejected. You know, this may sound a little like my view of the world, of course, but he was quite telling. My doctoral dissertation is one of those that took me quite a few years to publish, about 5 or so, and I kept running into adverse referees at various journals who essentially at the beginning were saying, you know, we don't believe what you're doing for different reasons. And by the time I was sending it to journals at the end of those 5 years, the reaction I was getting is, oh, we already know that there's no diversification discount. And I was like, of course you already know, I told you 5 years ago. So I think by now there is enough of that doubt, at least, about that interpretation. About corporate refocusing, yes, there is evidence that markets react favorably to it, but turns out that markets also tend to react positively to the announcement of diversifying acquisitions. And just like diversified firms prior to diversifying, refocusing firms also traded a discount prior to refocusing. And so to me, this tells a very different story, which is that when firms are outperformed by their competitors, which is what these discounts are essentially measuring, basically any change in their current corporate strategy is going to be welcomed by the stock market. And so I think based on this, I would say that the semi-strong form of the discount can be considered rejected too. About the weaker form, that the fact that the discount is just, that you see this in the data, but doesn't necessarily mean it destroys value. I have my doubts as well. I did some research on this where I took conglomerates and broke them into pieces, either according to segment data or according to a much more fine-grained database from the US Census. And basically what I saw is that for the same companies, depending on how you cut them into pieces, the discount turned into a premium. So I have my doubts about this too, but the truth is there is mixed evidence about this. And so I wouldn't say that the weaker form is rejected. We probably need further evidence. So summary so far, the notion of the discount in strong or semi-strong form is rejected. The conventional wisdom about the discount is challenged even in the weakest form. And so the managerial implications of this is that diversifying or staying diversified for companies that already are doesn't necessarily destroy value and may very well create it. And if a diversified firm is trading at a discount, carefully examine what's really being discounted before refocusing. And I think this is going to be quite relevant for some of these breakups that we are seeing. I remember years ago, some of you might remember as well, Tyco, which was another of these conglomerates, was trading at a discount, and they announced a breakup into 4 pieces, I think. And unlike most breakup announcements, which tend to provoke, as I said, a positive market reaction, the markets didn't budge. And soon enough, there was one of the biggest cases in corporate fraud in history that came up with Denis Kozlovsky. And so that's clearly the market was worried about something, but it wasn't diversification. And so breaking it up was not going to solve the problem. Anyway, just a couple more things. So the value of diversification across countries, I and others have done studies about this, and there is, of course, variation across countries, and it does seem to vary based on the degree of institutional development. And I did a study with Venkat Kupuswamy, also looking at the value of diversification around the recent crisis. And so we did in fact find that diversified firms increased in value relative to focused firms around the crisis. And we found support for 2 of these explanations I mentioned earlier. So partly the more money story, that diversified firms were able to borrow more money. It's something that perhaps may not kick in normal times, but might kick in when in fact credit becomes scarce, as it did during the crisis. And then we also find evidence of this smarter money story, that internal capital markets became more efficient as external markets were becoming more inefficient. So in the end, it was at least a relative comparison. What we never looked into, we never went back to this, of course, enough time has gone by that we could look into it, would be whether that advantage that diversified companies gained during the crisis persisted beyond it. Many of those pure play firms at the time may have gone bankrupt, and it would be hard to do the comparison, but they are not there anymore, and so it would be interesting to follow up. So I think I'm just basically going to leave it there and just say that overall I feel that there's more myth than reality about this idea of the diversification discount. And it's perhaps time to move beyond the question of whether there is a discount or not on average to questions of when and where you do see a discount. Try to measure those discounts for individual companies, countries in periods of time. We have already done some of that. Why? What are the benefits and costs of diversification? And of course, there's a lot of strategy literature that has looked at this, but I do think that there's a lot to be learned by sometimes digging deeper into individual companies. And again, how for particular companies and their businesses, how can we make sure that the benefits will exceed the costs? So with that, I am going to stop the presentation here and turn it back to Cinzi. Thank you.
Thank you very much, Belén. Thank you again, Bob, for your presentation as well. So I know we have both from the audience, the questions in the chat, but also we had a number of questions posted by people who registered when they register. So I'm going to draw on these questions as well. And I want to encourage you, if you have additional questions, please post them now. There's a lot of interest in understanding how digitization and platformization is affecting this this conversation and what we, the extent to which we can apply what we know about diversification to new to the companies that are the really large companies, especially the tech conglomerates these days. But before we get to that, and then Bob of course had a whole slide on precisely these questions. Before we get to that, I want to ask you two questions. Well, a set of questions about ownership structure and types of ownership. So Rafi Amit, when he registered, he asked about pyramid ownership structures. Should we think about them as diversification? And somewhat related to that, David Collis in the chat was asking he was proposing that private equity, which right now is perhaps as high as 4% of GDP, is a form of conglomerate. I'm wondering what you think of that. Do you agree? How would you suggest that we should think about these questions?
Me or Bob or both?
I leave it to you to decide who. Belén, why don't you go first and then Bob can weigh in.
Okay, thank you. So thank you for both questions. And Rafi's question is, I've been thinking a lot about this because, and I think I know where it's coming from. I have a doctoral student who is on the market, and by the way, I would like to recommend him to you all to the extent that you're recruiting. His name is Pedro Macul, and he's actually at UCLA, and his dissertation is precisely about corporate pyramids, and he's basically suggesting that these pyramid ownership structures are not created for purposes of enhancing control, which is what has been sort of the standard financial explanation to it, but more as a way to manage diversification more efficiently. And it's interesting. I think he's sort of bridging two different literatures there. I sort of think of pyramids as the way in which, say, the unit of analysis is a publicly listed conglomerate, or not conglomerate, but a publicly listed company. And so the pyramid structure, as I think of it, is how the ultimate owners control that publicly listed companies. And of course, that's where it leads to all these issues of tunneling and appropriation of private benefits, because you have some minority public shareholders that are subject to that expropriation. And then there's the ownership structure below it, which to me is more like org structure. And of course, that complexity, and Pedro does a very nice job at showing the links there between degrees of diversification and sort of the length and the width of the pyramid of that ownership below the parent company to the subsidiaries. And so I think there is a clear link in that bottom part, but I don't think the two are mutually exclusive. But thank you for the question. And to David's question about private equity, if I may, and then I'd love to hear Bob's answer. But I absolutely agree with you, David. And in fact, to this day, I still assigned to my students an unfinished draft that you wrote years ago with Cynthia about the LBOs as the new conglomerates, and I wish there had been a finalized version of that paper or some more follow-up, because I absolutely think that those are in a way the new conglomerates, and that they have also a lot to do with some of these trends that we are seeing in the sense of having become stronger competitors for some of the targets of acquisitions that otherwise would have been acquired by conglomerate companies, but also at the same time forming their own conglomerate. So some of these newspaper articles that we've all been reading these weeks were saying things like, diversification is dead, long live diversification, and or conglomerates. And this is one of the forms in which we are seeing them, together with, of course, some of these big tech companies and diversification through platforms.
Yeah, I'll start with the private equity issue. I think, David raised that issue a long time ago. I thought, what Belén said about that is really important, that they kind of replaced, as conglomerates were becoming less prominent, right? PE firms were becoming more prominent and very diversified. If you look at Carlyle or Blackwell, they would buy businesses, restructure them, and sell them. I have a piece that I might refer people to in the Academy of Management Perspective. I think it was published around 2016, something like that, on private equity firms, and have a kind of a diagram of those who are long-term versus short-term when they buy businesses. And it's it's a theoretical piece. It's differentiated between whether they have equity, and they're usually long-term, they keep the businesses longer, and they're more focused in the businesses that they buy, and they assemble businesses and then spin them off through an IPO. They're not just restructuring and spinning the businesses off after 4 years. So there's a lot of different strategies in private equity firms that, rather than just, we think of debt, right? LBO firms, and it used to be that way, but now there's more variety in their strategy. In regard to the pyramid stuff, I think in my mind, they are diversified firms, although they're really an ownership structure. I think there's an interesting piece in India by Prasant Kale and others, looking at these diversified business groups that one at a time create IPOs for their member firms, and that the overall value of these member firms goes up as you have a stock price, quarterly earnings reports or annual earnings reports. And because of the market exposure, have you a lot more transparency on what's happening with the member firms. The more stock they have publicly traded versus, and so you find that the discount goes down for these firms because there's just more transparency. It was published a few years ago. Prasant Kale is one of the authors. It's really an interesting piece, and it kind of talks about how member firms, as they become publicly traded, increases the look you have on the possible tunneling that might go on with the family, etc. And the implication is that tunneling is reduced a little bit as the transparency increases. So that's one possible look at that.
So we are unfortunately at time, and I think we want to make sure that we stay on time with these sessions for our audience and for our speakers. I think we leave all of you, both the audience and the speaker, with a really huge open question of what does diversification mean, and if the concept and definition of diversification or theories of diversification need to change as we're thinking more and more about platform companies and sort of digital economy. Again, Bob had already emphasized a lot of these questions for future research. I'm sure we can do a whole hour, maybe more than an hour session on that set of questions alone. So I'm not going to try to tackle them now. Instead, I'm going to thank again the speakers, Belén and Bob. Thank you very, very much for joining us and for your presentations today. Thank you to everybody in the audience for joining us for the session, being here and sharing your questions. And thank you again to Katie Magelssen, who is the organizer of the Corporate Strategy Masterclass series for the SMS Corporate Strategy Interest Groups. Thank you again. Have a wonderful rest of the day, wherever you are, and we hope to see you in the future at similar events.
Thank you all very much.
Thank you.
Thanks, everyone.